on. I'm just going to hold it. Welcome to lecture 4, Interacting with Bitcoin. Nate and I are lecturing again this week. So we're going to take you through, we're going to take you through wallets, how wallets work, how to interact with the actual Bitcoin network, what the different types of users are, mining, and then some more. So a couple of announcements. We announced your first discussion assignment last week. You have 2 weeks to complete those discussions, so just make sure to get your post in before we meet next week. And then you also want to reply to 2 other students. We've already been looking through some of your responses. They're awesome. It's a really cool way to learn about a use case that you probably would have never been exposed to otherwise. And also for yourself, you can do some research.
Okay, and then one thing about attendance. So we're going to try something new starting this week. We're going to send out a form. So if you have either miss lecture completely, miss a part of it, or if you even forget the code and forget to fill out the attendance on B courses, then just fill out this form. And there are a few questions on there, and then we'll be sure to update your grade on B courses. So hopefully this will be a more efficient way for all of us to, to work through that. And one thing about the quiz from last week, quiz 2 was really tough. I know it was a lot more difficult from the past ones, so don't worry about it. That was just naturally a more technical lecture. So there are going to be a few quizzes that are pretty tough, but just give it your best shot. Try to do as best you can, and it'll be totally fine.
Okay. Yes, exactly. Okay, so lecture overview. Nate's going to start off, take us through the different types of users in the Bitcoin network. Then we're going to get into wallets. Yes, it's you. Then we're going to get into wallets, how wallets work, how do you generate a wallet, how do you interact with a wallet, what are the different types of wallets. Then wallet mechanics, so the details of wallets. Then mining, this giant buzzword that you hear all the time with blockchain, but actually, like, how does that work? We're going to talk about how that works. And then mining in the real world and what it actually looks like. I can do types of users. All right, types of users. So in the past lectures, we've talked about full nodes for the most part. So these are users that have downloaded the entire history of the blockchain. These are users that are mining. These are users that literally have everything that you need in order to mine on the blockchain. But not every client is a miner. So if you don't have a powerful computer, then what if you just want to send Bitcoins with your phone and you don't want to download the entire history of the blockchain? There are ways to interact with the blockchain without needing a giant ASIC computer to interact with it. So, because if you did, then it would be super inaccessible. So you're not directly connected to the network all the time. You don't always have a wallet. Sometimes your wallet is separate from the blockchain network. So there's different ways to interact with the blockchain itself. One of these ways is an SPV node. So SPV stands for Simple Payment Verification. This is called a light node. So this is not a full node. A full node is what you see up top. That's a reference client. So that's Bitcoin Core that has the wallet, that has miner, that has a full blockchain database, that has a network routing node. So that's how you interact with others on the peer-to-peer network. So that's a full node. That's everything that you need to operate as a full node. An SPV node, which is below, is just the wallet and the routing and the network node. So an SPV node is just to keep track of only your transactions, and it's called a lightweight or a thin client. So this is a method for verifying if a particular transaction is included in a block, without downloading the entire block. So if you only care about your own transactions, you just want to see what's happening with my transactions, you can run an SPV node. And so one kind of catch with the SPV node is that you're assuming that the incoming block header is not from a false chain. So since you don't have the entire history of the blockchain, you can't verify whether the incoming block header is the longest chain or if it's been tampered with or all that, because you're not operating a full node. So you're going to connect to many different nodes, and long term, the chain that you're receiving is probably honest. So you can't really afford to put the entire blockchain in your phone. It's a decent trade-off if you're just trying to verify your own transactions, but that's the trade-off there. Questions? Yes? Yeah, if you don't care about mining Bitcoin, you wouldn't operate a full node because it's going to take up a lot of. You would not. Yeah, so that's when if you just care about your own transactions, then you would operate an SPV node. Yeah. Yes. Would you, sorry? If you care about validity, then you wouldn't operate an SPV node, probably. If you really are like, oh, I want to verify this, then you'd probably operate a full node. Cool.
Okay, sweet. So I guess we'll get into. Okay.
Do you want to do this?
Whatever you want to do. No, go for it. Whatever you want to do.
We can share it. Okay, so now we're going to get into what wallets are. So to secure our identity, we need to secure our private key. This is the most important part of interacting with the blockchain network. You cannot share your private key with anyone, but like, how are you supposed to keep track of that series of letters and numbers? You manage them with wallets. And the main thing that wallets offer users is an interface to the blockchain. So it's how most users are going to be interacting with the blockchain. They keep track of your private key. You can store, send, receive, and list transactions in your wallet. And depending on what kind of wallet it is, it might have some other functionality, which we'll get into. Here, we can look at different wallet types. This is a pretty cool exercise. So on Bitcoin Core, bitcoin.org, they walk you through how to choose a Bitcoin wallet. So it's like a little helper. So you can choose what your operating system is. Let's say I just want to keep it on my iPhone. I have an iPhone. Next, it asks you how much you know about Bitcoin. I'll say I'm new. I don't know a lot about Bitcoin. And then it asks you about specific criteria, which we don't really care about right now. A lot of this we haven't gotten to yet, so we will just skip. And then it gives you a list of wallets that are compatible with the selections that you chose. So I don't really know. Let's just click this. Gives you specific features. So since you're a new person to Bitcoin, it says it's one of the easiest wallets for new Bitcoin users. It includes a little picture right here, so you can see it almost resembles a PayPal or a Venmo. It has send, receive, buy, and then it also stores all of your addresses for you. And then it's pretty good at privacy, full control over fees, et cetera, et cetera. So that's just an example of what a wallet can look like. We'll get into different types of wallets in a second with different examples. Do you want to go over hot versus cold wallets?
Sure. Okay, so there are two main types of categories of wallets. The first we see, we'll get into hot and cold wallets in a second, but let's start off with hot wallets. And so the big idea of hot wallets is that, like the biggest differentiation is that we see that hot wallets are things that are connected pretty much directly to the internet, or they're connected to the outside world somehow, where cold wallets are not. And so just taking into hot wallets, these are probably ones that you're more familiar with. These are ones like Coinbase or other, what we just talked about too, with like what Ava just demonstrated. But these different types of wallets are connected to the internet, are all pretty much on your phone or computer, and are pretty easily accessible. And what we see on the other side is cold wallets. And these are, and we'll go over a few examples, but these are things that are kind of creative ways to keep track of your public and private keys. And so something to keep in mind is like a big difference between wallets as we think of like a physical wallet and wallets for Bitcoin are that your physical wallets hold money, but when we think of like our Bitcoin wallets, these are what store your private and public key rather than actually storing any value or currency there. So just to go over some examples of cold wallets. So this is like a hardware wallet. What this is just something that you plug into your computer, and then it's a way to be able to send and interact with Bitcoin or different currency all through your computer through this different chip. And so, yeah, that's one example. We also have paper wallets, and because wallets only really hold your private and public key, you can write them down. And so what this website will do, I think this is, bitcoinpaperwallet.com. It will randomly generate a public and private key for you, and then it'll tell you to disconnect your Wi-Fi, Ethernet, internet, whatever you use to connect to the, however else you connect to the web, and then it'll generate it for you, and then kind of it provides you with your information. And then another common, this is kind of more radical. It's one of the more radical wallets, but it's the idea of your brain wallet. And so it's keeping track of and actually memorizing your private and public keys. So this was a.
Okay. Stop. Okay, this was a meme from a couple years ago, but it has using a recommended Bitcoin wallet, storing crypto on a hardware wallet, writing private keys on a Post-it and putting it on your computer, memorizing your private key, memorizing the QR code, or storing your crypto on Coinbase, which I thought was kind of funny. No one laughed. Okay.
Got a few chuckles. Do you want to take this
You can also store brain wallets as a mnemonic. So these are called seed phrases. So it's a collection of words or phrases, which is much, much easier to memorize than this whole private key here, obviously. And so it's a convenient way to memorize your private key. It's easier to have something that you can turn into your private key, but it's not that secure because we're not as random as we think we are. So when we come up with words like this, sometimes it's actually pretty easy to guess. So for example, you can memorize these seed phrases and then type that in, and then that links to your private key. And so the different types of wallets, this is showing you from cold to hard wallets. Pretty much the trade-off is security and convenience. So using Coinbase is incredibly convenient, but you're also susceptible to all those centralization issues that we went over in the very first lecture. So they have your private key, they have all your addresses, and they own those. So if anything were to go wrong with Coinbase, and you lost your private key, like, sucks to be you, because they were storing it from the beginning. And then sort of moving from right to left in terms of security, you see that you're kind of giving up some of the user interface usability that you get with Coinbase as you move into Bitcoin, the Bitcoin Core wallet in the middle, and then going all the way to the cold wallet, Bitbox, that's incredibly secure, but it's not super convenient. You have to plug in a flash drive into your computer and then connect it to the internet every time you want to sync up, how much Bitcoin you currently have on your wallet, and then disconnect it from the internet to, store it cold. Questions? Yes, it's gone. If you store it on a flash drive and you lose a flash drive, yeah, completely gone. So that's why that's so convenient on Coinbase. They have a little forgot your password button, and then they'll send you a renewal link. But with the cold wallet, you can't do that. Yes. Yes, but the private keys on the Bitcoin network is attached to Bitcoin. So it's effectively also storing your Bitcoin, but it's only storing the addresses, if that makes sense.
Make sure you repeat the questions too.
Oh, right, sorry. Yes? If someone were to steal the flash drive, is there any protection? No, unless you had the private key stored somewhere else. But in that case, that person still has so you would just have to kind of get those private keys out of that wallet as fast as possible and into a new address, I guess, in that scenario. But because that person, if they have your private key, they can send and receive those Bitcoin just as easily.
Yeah, and we'll get into this idea of like HD wallets or like hierarchical deterministic wallets, which kind of gets into how different things can be stored. And so hopefully some of your questions will be cleared up in a minute too.
Okay, so we're gonna do, oh shoot, where's the discussion? Okay, it's on your side. We're gonna do discussion a little bit later.
Okay, so I know we've talked about this a little bit, maybe in the first lecture, but you may be wondering where you can actually get Bitcoin. And so a few years ago, Coinbase was not around, and so you couldn't just go online, pay with a credit card or whatever other form to directly get Bitcoin or cryptocurrency. And the ways you have to do it back in the day, which was a few years ago, was through either like physical locations. And so actually around Berkeley, there are a fair amount of Bitcoin ATMs. And so these are just places where you can go and you can deposit money and make these transactions. And what they'll do is it'll print out it'll either transfer things to your private or to your public key, or it will give you generate a new public key for you and private key in which you can access and use this Bitcoin. And so like Ava is writing right now, well, pretty much it's just an example here. This is at a Coinstar at a Safeway. And it just shows how you can deposit coins and get Bitcoin. And so you can see that gray box right there just shows how easy it is nowadays to get Bitcoin. And then I believe Ava has an announcement about
Punjabi Daba has a Bitcoin ATM.
So that's she got really excited about that earlier today.
It's an Indian restaurant on Durant.
It's a restaurant on Durant. Some other ways are through exchanges. And so there are two main types of exchanges. First, we have centralized exchanges. And pretty much these are just ways that different groups trade. And it's pretty much just like trading between different types of currency. And so some of you might see some red flags here, which is the idea that having a centralized exchange kind of detracts from the mission of Bitcoin as a whole, which is that there shouldn't be these parties that are able to run and kind of operate these transactions, because this is exactly what a bank does. And so that's one of the concerns that comes up with centralized exchanges, which is why we've seen a greater transition towards decentralized exchanges. And so these are fully peer-to-peer, and these exchanges don't rely on either like a third party or someone to facilitate these transactions. And so within decentralized exchanges, we see that, and like we have a little pros and cons on the right side of the slide here, but we see like the big thing about decentralized exchanges is one, everyone's like anonymous, and we don't necessarily see any third party that has the possibility of like running away with these funds or acting maliciously. So all the power is in the people who are trading. So the power goes directly towards those people. Okay. And just like we saw with different types of wallets, there is a trade-off between both types. As we see with some of these centralized exchanges, they are really easy. And so it makes trading, buying, and selling Bitcoin and crypto really easy. But at the same time, we lose some of that security. And if we don't necessarily trust these exchanges, which nowadays we are arguably trusting more and more, we don't know if we necessarily want to trust these centralized exchanges and fully put all of our money into these people in the hands of these people, which is why we see like for a more secure option, we can rely on decentralized exchanges. And so one of the big downsides there, like Ava mentioned earlier, is there is no like I forgot my password, or there's no way to recover your public or your private key if you lose it or forget it. And so that's why we see that nowadays a lot of people are turning to Coinbase or Kraken for like a recovery option if they lose or forget their password, and for just ease of access. Okay, any questions there? Yeah. So the difference is people have, so there are different accounts that are now connected. And so when you sign up, maybe you'll sign up and attach your email, phone number. And so these other components are kind of creating more of an identity for you. But this is done and typically only stored and given to, like used for Coinbase purposes, not necessarily for interacting with other people. But we do see like those lines be blurred a little bit of the fully anonymous or like pseudonymous components. That's up to you. Depends on what you value more. Oh. Which one's better? And that's the thing is it is a spectrum too. And so you have ones that, well, actually, it actually isn't really a spectrum, but pretty much, it really depends on what standpoint you're coming from. And so for me, I'd say in terms of like widespread Bitcoin adoption, centralized exchanges, while you do give up some of the privacy and autonomy, they are allowing more people to get involved with crypto. But
well, why don't a lot of students in the class, I think, have interacted with exchanges before, so why don't you raise your hand if you've ever used a centralized exchange, like Coinbase, etc., and then put your hands down, and then raise your hand if you've ever used a decentralized exchange. So we have a pretty healthy mix. Has anyone who's used a decentralized exchange, do you want to speak to your experience with it? Yeah.
There was like a market kind of dip back in like March, and most of the centralized exchanges like Coinbase, Binance, they all went down, or they at least had periods of like inactivity where you couldn't use their services, so you couldn't sell or buy if you had wanted to. But all of the DEXs were operating just fine. So I've never seen one like go down because of high volume or traffic. So that's like one of the. Plus, you don't have to KYC, so.
Which DEXs have you used?
Uniswap, PancakeSwap, several others, yeah.
Cool. Thank you. Anyone else want to add to that? Ooh, that's be hard to get to.
In terms of transaction cost, centralized exchanges are generally cheaper because for decentralized exchanges, they are usually on ERC20. And gas fees are really high when they get popular. And there are a lot of like copycat decentralized. Right. And basically they can just get hacked or they rug pull. So I mean centralized exchanges for those who have existed for like a few years, I think they are more trustworthy and they have a lot of other instruments that you can use to bet on the prices. So
Got it. That's an interesting point, how decentralized exchanges, because a lot of them are running on Ethereum, have high transaction fees right now. I'm going to do one more, and then we're going to, sorry.
Oh yeah, so the cool thing is that you can provide liquidity for the transactions on decentralized exchanges, and you can do yield farming with them. So it's like a good passive income. A lot of those coins on decentralized exchanges are rug pulls, they're scams. So a lot of shady tokens out there. PancakeSwap, Uniswap. So like it's mainly for ICOs. So you mainly use it for the liquidity pool? Liquidity pool or like investing in new tokens.
Thank you. What's your name?
Vedant.
Thank you. All right. Thank you guys for sharing. So those are some first-hand experiences with decentralized exchanges, which feeds very well into our discussion, which we've kind of already started, but we're hoping you guys can discuss amongst yourselves. What are the pros and cons for centralized exchanges and decentralized exchanges? A lot of good pros and cons have already been said. And then secondly, which wallets are suited for which kinds of users? So get to know the people sitting next to you, have little discussions. Nate, JJ, and myself are going to walk around if you have any questions, but feel free to just discuss amongst yourselves.
Yeah, we'll take about 4 to 5 minutes to talk, and then we'll come back together as a group.
1 more minute to wrap up. Everyone. Hello?
Yep.
I'm on.
Yes. Okay. Hi, everyone.
Thank you. It didn't really work.
Sweet.
Okay. Happy you guys are having some good discussions. Did anyone bring up any points that they want to say out loud to the class? I thought were really interesting. I know we already had a lot. Yes. Totally. So that's definitely one of the pros of decentralized exchanges. Anyone else? Cool. What did you say? Oh, you technically do, but yeah, no one's checking. Yet. Yes. Yeah, so that's the whole conveniency versus security aspect. Definitely easier to get to. Yes. Totally, totally. Totally.
Yeah, and so that's the difference between, and that's kind of how I think about centralized versus decentralized exchanges. And we see with centralized exchanges, they're kind of more for, and not, this is isn't really even the case, but it's easier to start with a centralized exchange because there's like customer support from Coinbase or even from Kraken, and these companies that'll help you if you have questions, and they'll kind of escort you along the way. But then if you want more autonomy and want to start to do your own thing and like, choose your own adventure, that's where we see a lot of the merit from decentralized exchanges. So not having to rely on this custodial party. So the whole origin for Bitcoin was due out of radicalism in the sense that at a certain point, like so much is owned by banks and by the government that this is kind of posed in a scenario where we don't want to give anyone outside of the person sending money and the person receiving money any power whatsoever. And so that's where kind of in this mindset, that's why we see this idea of security in the sense that you can't even trust these companies. And like, we've heard about, I'm guessing a lot of you heard about kind of like the Facebook data breach and kind of how information was distributed in that like a few years ago. And that's just one example of like a really large company that most people thought was like very trustworthy, but instead was doing things behind the scenes that weren't fully ethical. So, yeah, one more question. Yeah. What ways can you cash out? Well, in the same ways that you cash in. So either you sell. Oh, so you're looking. So if you want to avoid tax, you want to fly under the radar. So you're gonna need
Is this a real question you're asking for yourself?
Okay, so you're gonna need 3 new passports from 3 different countries, complete different identities, and from there. No, a lot of times so that's the thing is the government's starting to have more and more of a role, and so pretty much anything that you might think in terms of tax evasion has probably already been thought of and is already being monitored. So.
I don't have capital gains tax there.
Yeah, no capital gains tax in Puerto Rico. Yeah, do a quick question. Well, how about that? I'll let you research that and write about it in your discussion so we can all find out. Okay, well, let's go on to wallets. I don't care, I can do it. Okay, we're just gonna do a quick, well, pretty much the slides are posted, so we're not gonna go through this whole demo right now. These are a few ways that you can create a wallet if you're curious and you wanna get started on some of these exchanges. So,
Yeah. So this is kind of cool. It's called walletgenerator.net. If you have MetaMask installed, which is like an Ethereum extension where you can access your wallet, which I have MetaMask installed, so I can't click on the site because it won't let me. But you can do it. It's cool. You like click around the page and it randomly generates an address for you. So you can try that, walletgenerator.net. This is login.blockchain.com. We can go through it, but I have all the photos here. You can also just search for one online. I think it's a cool exercise to see how wallets are made. Just look up how to create a blockchain, Bitcoin wallet, whatever you want to do. So here it says welcome back. You put in your wallet ID, password. You do have to put in your email address here. And then you can buy crypto once you put in your email address. And this is what the interface looks like. You see send, request, swap up there. You can send and receive Bitcoin like that. I think this is also an exercise that's good to do on your own. So feel free to, a lot of you have your laptops out. You can do it right now, or you can do it after class. Probably after class, Nate says. Questions? Cool.
okay, so we're gonna go into a few things about wallet mechanics. So to start things off, so there's pretty much this idea of multistage just refers to like multiple person and like account access. And so you might have seen in movies, like if there's some like big government like underground project, and they need like 2 people to put in keys at the same time and turn them before they can like press the button. Pretty much it just takes multiple people to authenticate this account and to gain access. And so pretty much there are different like kind of distributions for, or maybe not distributions, but different like combinations of signatures and keys that are required to access these accounts. And this just makes sure that well, I guess let's give an example. So imagine you have like a family account and you want these decisions to be made by like the majority of the family. If there are 5 people in the family, then you might need 3 out of 5 signatures to access the funds that are within this account. And so, yeah, this is pretty much just a way to demonstrate it here. We see that for someone to access, like for Elon to access this account, it takes 3 other people to all kind of put in their credentials and authenticate this account so that Elon can access these funds. And then just to get into some practices of how, like if you are interested in working with wallets and making them, and whether they are like multi-sig or just regular different forms of authentication, a few things to keep in mind. One is like never reuse like your pseudonym or your name or your public keys. And so this just makes sure that all your different accounts are separate because, and we'll see this in a second, if you have one account that gets hacked and they're all linked somehow, whether it's like if you have like one big password and you reuse this password for a bunch of different wallets, then we'll see, and like I guess like password, like loosely speaking, then we'll see that someone who gains access to this one password can access all of your information or however many things you have linked to that one account. Okay. And then, so we'll talk a little bit about the idea of HC wallets or hierarchical deterministic wallets. And so this is a little bit what I talked about a few seconds ago, but you can have wallets that are all like intrinsically linked. And as you can see kind of the tree structure from here, we see that if you have a master key, you can link all like different keys or different forms of authentication all to this first key. So maybe one will access the other, which will access the next, and there can be kind of this chain of command. And so as we see, the master key at the top kind of determines all the other keys and gives access to all these other keys. And so from there, this can be seen as a positive because you only have to remember one password or one bundle, like only a single bundle of information. But at the same time, it can be problematic because if you do lose or you somehow this one master key gets compromised, you lose everything that follows in the tree and like all the other keys that are linked to it. So depending on how much you trust your one key, this might be a way to go, but you want to make sure that it is really secure as best as you can make it. And yeah, I kind of talked about this too, but everything's linked to one key, and there is like a control flow, and so there is this progression of like this chain of command, but it can be seen as a negative because you could lose, if you lose one, you lose it all. Okay, and then just to get into like kind of the technicals about this a little bit. So the way this works, if you're thinking about how you're generating these, so you start with your master private key, and from there you generate your kind of like you start with the parent key and you generate the child ones. So all the ones that that follow it after, and you can all do that by hashing your different keys together and like working with hashing algorithms to do so. Okay, I won't get into this too much, but pretty much this just talks about the general idea, which is that because of like the hash functions all being linked somehow, just like the keys are linked, that's how we can use the one key to access the rest. Any questions there? So it depends on if you have different accounts, or a lot of times it's if you do have different like, public keys that you want to, and you said extended public or private key? Oh, this? Extended public key. Yeah, so this just comes from different accounts. And
Yeah, I can also answer. So a lot of the time we create multiple public keys because we don't want anyone to know how much Bitcoin we have, or in this example, Bitcoin. So because the network, like we talked about in prior lectures, is pseudonymous, they won't know, oh, this belongs to Ava, but they'll see this Bitcoin address, ABCDEFG, has sent 10 Bitcoins here, then sent 2 Bitcoins here, and has received 30 Bitcoins in the past month. I know exactly how much Bitcoin now is in that account. You don't really want anyone to know how much Bitcoin is ever in your account. So that's why you generate multiple public keys so that you can use different public keys for different transactions and kind of disperse what you own among those addresses. So no one ever knows how much you own because they can't track all of your Bitcoin to one address, if that makes sense. Yeah, so basically like an HD wallet, I don't want you guys to get too caught up in this because this is like a very specific application of wallets that no one, like you don't have to use ever or understand how it works, but we're just going over it because it's kind of an interesting way to look at wallet generation because yeah, so basically you have one master private key and then you are able to create different private keys based off of that original one and store it in like a very structured hierarchical way. And the reason you would do that is for the reason I just said, if you want multiple addresses, but you can also just randomly generate 10 different private keys and that works just as well. So this is just one specific way to do it. Yeah. Okay, so go to the UK. Okay, I think he literally just left, but I'll let him know. Thank you. Thank you. Okay, cool. We'll move on. Mining, exciting, buzzword. Okay, so we're gonna go over what mining is, top to bottom. We'll go over it for questions at the end, but hopefully you'll be able to walk away with a real solid understanding of what it means to mine and to be a miner. So a full-fledged Bitcoin miner must first download the entire Bitcoin blockchain. So the entire history of the blockchain needs to be downloaded in order to be a miner. You also need to verify incoming transactions. And so we'll go over this in greater detail, but essentially you have transactions coming at you as a miner, and you need to verify that these transactions are valid. And then once you verified all the incoming transactions and you have collected those transactions into a Merkle tree, and you have your Merkle root, which we went over last class, then you can create the block. So the block has the hash of the previous block header, which you have because you've downloaded the entire history of the blockchain. It has the Merkle root, which you have because you verified all the incoming transactions, and it has a nonce. So then once you've created this block, then you're just trying to find that valid nonce, and you're just creating you're going through random computational methods to try and find this nonce. And then if you find the valid nonce, then you broadcast your block and you send it to all your friends and you say, look at this block I found, I'm so cool. And then you get your profit. And going into, thank you for laughing. So going into step 1, you download the blockchain. So what does it mean to download the blockchain? You get blocks from your peers. Whenever someone broadcasts a block and you verify it and you say, okay, this looks cool, then you're gonna download that block from your peers. You're gonna download the entire history of the blockchain before that, starting from the very first block, which is called the Genesis block, and then you're gonna stay up to date. So when a block gets broadcasted to you and it checks out and it looks good, you're gonna add that to your local blockchain, and then you're gonna move on and you're gonna keep mining for the next block. And something that's interesting here is that when you receive a block, some people say, okay, well, if I'm trying to mine the next block and I receive the next block, which means someone else has already found it before me, why don't I just reject that block and say, no, I'm not accepting it. I'm gonna keep mining my block until I find it and I get the reward. And the reason why you don't do that is because everyone else is going to accept that valid block and you're gonna be one block behind now. So if you actually want a shot at getting that block reward, when you receive a valid block, you say, oh shoot, I didn't find it, you move on. You put that block on your local chain and then you move on to the next block because you get the highest likelihood of actually seeing a profit by doing that. Okay, and then next step, verifying transactions. So you're listening to the network for transactions, and whenever a transaction is pending, so it hasn't gone through yet, it's not on the blockchain, but I have basically put in a request for a transaction, let's say, then that gets sent to the mempool. So this is it's called a mempool. You can just think of it as the pool of transactions that are waiting to be added to the blockchain that a miner has. And then you're gonna verify those incoming transactions. And one thing to note is that there may be 4,000 transactions in the mempool at a time, but the miner can only collect 2,000 transactions to place into the block. So you're gonna ask, how do you choose which of the 4,000 transactions to be added to the block? And the way you choose is by transaction fees. So each of these transactions has a fee associated with it, and the miner is obviously incentivized by profit, so they're gonna wanna maximize that profit, and they are going to they're gonna order the transactions by the fee, and they're going to place the top 2,000 transactions in that block. And then another thing that we'll go over later in lecture is what happens if the transaction fees are too low and they get stuck in the mempool. We'll go over how to deal with that when that happens. So you verified all the transactions, you've collected it into this lovely Merkle tree, which I'm not gonna go over because we went over it last week, but you're gonna gather those transactions into a block, you're gonna choose whichever, like I just said, choose whichever transactions you want, and then you're gonna get the previous block hash and other necessary metadata into the block header, and once that's all set up, you'll move on to find the nonce. So we actually named this first transaction after Coinbase, the company. Just kidding. So Coinbase, the company, is named after the very first transaction in a Merkle tree. Fun fact. So this Coinbase transaction is essentially how the miner gets the miner's block reward. So right now it's 6.25, I think, right? 6.25. So the first transaction in a block on the blockchain will always be 6.25 Bitcoin sent to the miner. That's called the Coinbase transaction. So whenever I find a valid block, I get 6.25 this time. I think in 2024 it's going to get split in half again to 3 point whatever. So the Coinbase transaction is the miner getting the Bitcoin for themselves. Then you're going to find the valid nonce. Again, we went over this last time. The nonce is that random number that's just going to complete this puzzle. It's going to be when you hash the previous block hash with the Merkle root with the nonce, you need to get a value lower than the target value for that block. And if you get a value lower than the target value, then congratulations, you found the nonce, you found a valid block, and then you can start broadcasting it to your peers. This is the current target right now. It has that many leading zeros. It's very difficult. And then you're going to broadcast it. So what do you do when you broadcast it? Let's say Janice found a new block. I'm like, oh my God, you beat me to it. So then we all start checking it. Are the transactions valid? Is the block header less than the target value? How much mining reward is attached, etc. If we check it out and it looks good, then we accept that block. If you see here, this is Janice's block. It's green. It's solid. It's good. Math checks out. And then you see Nate says, no time to waste. Let's try again. So now he was looking for the block, but the block has been found. He needs to move on and just start building on that longest chain now. And last step is profit. So mining is a competition. The longest chain will always rule. And you get the profit from, so the Coinbase transaction is how the miner gets their profit. It's from the block reward and all the transaction fees that were aggregated into the Merkle tree. If your block is not included in the longest chain, then your block may not have been the first valid block that was seen by others in your network, and then you just have to start mining on the next block. Okay, cool. A lot of information. I saw a lot of hands go up while I was talking, so now feel free to raise your hands again if you have any questions. Yes? Yeah, so the way that miners decide which transactions to place in their blocks is based on transaction fees. So each transaction has an associated fee, and they're going to order the transactions by highest fee, and they're going to accept as many transactions as they can, ordered by how large the fee is that they would receive, if that makes sense. Yes. So they're all looking for the next block on the blockchain, and then they all have a set of transactions in their mempool that they're grabbing from to add to that block. And the reason why they're incentivized to add those transactions, instead of just you can say why don't they just add the block and collect their Coinbase transaction and move on? Why do they even do this for other people? Why do they even include other transactions? The reason why they even include other people's transactions is because there's a fee associated that goes straight to the miner. So they collect transactions based on how high the fee is. Yes, those fees get sent to the miner. Good question. Yeah. What are those, sorry? Future prospects of mining? I mean, that's a definitely a concern, I'd say, because what was that? Because as the Bitcoin block, the Coinbase reward keeps getting chopped in half, the reward for mining is going to go down, but the idea is that transaction fees are going to go up. So as that reward goes down, the idea is that the fees are going to get higher, so the miner's reward is probably going to stay somewhere around the same. Yes? Does mining for all chains work the same? So Ethereum, yes, Ethereum does work like this. But not all chains work the same. We'll get into consensus mechanisms in that lecture, and we'll talk about how different chains work. Yes? So it's possible that you can choose whatever transaction you want as a miner. I can pick the lowest transaction fee transactions to put in my block. It just wouldn't make sense because I'm trying to maximize my own profits. So they can pick and choose however many transactions that they want. So it's possible that two different miners will have two different blocks. Yes?
Well, yeah, that just gets into why we have different types of nodes too. And so, we talked about at the beginning, it's there are some that don't necessarily need to have this whole blockchain involved because most of what you need is in the hash and kind of the information from the previous block. And so it really depends on it's all kind of outlined by different parameters within each different network, and they determine how much of maybe the blockchain you need and how much you actually need to be interacting with. And it's very up in the air because it changes for a lot of different protocols that I can't really give a blanket statement, if that makes any sense. I think we'll do one more question. Yeah. Sorry, can you say that one more time, please? How do they figure out the transaction fees? So we'll get into, it's a great segue into the next section, which is incentives. And so, one second. So this is just the whole idea of, there's no one in charge and there's no consequence necessarily for acting and trying to hack the network if you're acting maliciously. And so pretty much we can't, one of the biggest challenges with blockchain is that we can't really enforce any punishments. You can't send someone to jail for trying to tamper with the network, which is why incentives are so important in the networks being up and running and acting efficiently, and just all running smoothly. So if there's one takeaway from this section, everything that you'll learn about mining incentives come down to one word, which is profit. And so what we see is that just kind of looking pretty, like at the most basic sense, like profit comes down to, it's a combination of revenue and cost. And so you want to maximize the revenue you make, and you want to minimize your costs so that you can make the most profit. So just kind of looking at a few of the components that go in, so some inputs here. For starters, for mining revenue, this comes both from like the block rewards that you get and from the transaction fees. And so these are the two components that make up your revenue. And on the other side of that, our costs are derived from the fixed costs and variable costs. And so we can think of fixed costs being maybe like a computer system or whatever you're physically using to mine the Bitcoin, and variable costs, which might be energy use or whatever. It's all dependent on the algorithm, on the like consensus mechanism, whether it be like proof of work, in which case would be energy, proof of stake, which might be any like actual currency that you put up. And so we'll talk more about different ways later, but pretty much these are what we take into account when we're trying to find a profit. So a few things too. With Bitcoin, some of the incentives come from having a kind of a very fixed cap, and is a finite amount of Bitcoin in circulation. And the reason why this is important is if we had some arbitrarily large number of Bitcoin and there's no cap, then just from basic principles of like supply and demand, if there's no limit to supply, then we won't see the demand acting in the way that actually gives Bitcoin value. And so by having this fixed market cap, or this fixed level and supply cap of Bitcoin, we see like this starts to build our like economic model of incentives here. So thank you, Ava. And so what we see too is rather than actually ever reaching this point, we see that, so currently the that's what it is. So currently for every block mined, the person mining makes 6.25 Bitcoin. And so what this means, I guess now this is very different from in 2010 or 2011. But what we'll see is as we start to approach this, and I think we're around like 19,000, 19 million Bitcoin in circulation. As we start to get closer and closer, we'll see that these rewards will half and half. And so if we're looking at this green curve up there, it starts off really large, and now as we're getting closer and closer to all the Bitcoin being in circulation, less and less will be released into circulation. Now, just to get into a few of the incentives, for starters, so we know that profit is a key motivator for everyone in the system. And another thing to keep in mind is we want to make sure that all the transactions, like and this is to limit double spending or other types of attacks we have, we want to be able to incentivize honesty in our network. And so what we see is when we have more honesty, we're sure that everyone will be kind of approving the right blocks and things will be running smoothly, and we'll just have a more secure network as a whole. And so because everyone is pseudonymous, there's no way to really track who is being honest or dishonest. So we want to make sure that everything can be rewarded rather than punished. So that's what we do. We in Bitcoin, we reward honest nodes so that those who are working honestly will make more money. So this is a big question that comes up is this. So how are miners incentivized to be honest in their mining? And why isn't it in their best interest to mine empty blocks? And the reason for this is we see that if we have high rewards, whether it be from transaction fees or from just block rewards, we will have people who want to mine and they want to get these rewards, and so they'll do this through acting honestly. And so, we kind of talked about that. But if we want to increase this too, and want to increase the revenue and profit for these people who act honestly, then we'll just increase the different rewards, and we'll do that. So now we'll just get into a little bit about like an example, and this is kind of like a flow chart to demonstrate transaction fees. So we talked about the UTXO model in the first lecture. So let's say the input here is this UTXO has 5 Bitcoin, and so let's just say that 3 are being sent from this person, let's say the input person. So this first UTXO of 3 Bitcoin is being sent to some recipient's public key, and then maybe 1 Bitcoin is being sent back. But we do have this output UTXO, and what this does here, this bottom one, demonstrates the transaction fees. And so I know we kind of skipped over this at the beginning, but rather than being just 2 different UTXOs that are sent out, there are normally 3. That means so 1 to the recipient, any UTXO left over, right back to the person who sent it out initially, and then a little bit is being like sliced and given to the person who is like to the miners, and that's where a lot of the money comes from from participating in Bitcoin mining. So you could probably take a look at this after, but this is just a way, and there are ways to estimate fees. And it is kind of a really delicate balance when it does come to estimating fees for miners, because at a certain point you don't want to give up too much money, and you never want to overpay for the transactions, and because just realistically speaking, you're not going to pay like $25 for a burrito from La Burrito or something when you know that like the price that they have is much lower than that. So that's like one side, is you never want to overpay. But on the other side, you want to make sure that you have enough incentives and you pose enough so that it is desirable for people to pick it up. And like Ava talked about, there are transactions that are just left in the mempool and no one really cares about them because the fees are too low. And so a few reasons for this, maybe we see that, and actually we'll talk about this in a second, but you want to find this whole idea of the fee estimation algorithm is all done to find a balance between not paying the miners too much or not paying them too little. And so let's just say we have a transaction that's been left in the mempool and it's not really being picked up. What's a way to maybe incentivize people to pick up this transaction? And this just comes from the idea of fee bumping. And so bumping is really just a way to add a little more incentive for people to pick up a transaction. And so, like I said, transactions can get stuck in the mempool, kind of in this kind of amorphous area where no one is really acting on it and no one really wants it. And so if the fee is too low for a transaction and no one picks it up, then we can find that there are different ways to combat this. And so, and like the ways why we might have something that's too low is if there is like a raise or a kind of change in the minimum fees, so maybe the minimum fee prices rise, then it kind of levels the playing field. Like let's say I'm gonna just put it in dollar terms, also I offer $15 for this transaction, and like the minimum is around 10. Well, if that bumps up to 15, then mine's just gonna blend in with all the minimum prices and no one's gonna wanna buy it. So there are a few solutions to this. So you can pretty much offer up more fees involved. And so this is the idea of the replace by fee. And what this does is it provides additional incentives into like that come from picking up the next transaction, and so that it can actually find its way out of the mempool and into reality. And another idea too, a lot of times this is from the person who is initially making the transaction and it's not really being picked up. But what we see for the child pays for parent, the difference here is that like we see that the user creates a new transaction which spends one or more of the outputs on the stuck transaction. And so it's pretty much a way of like overriding this transaction, and rather than trying to add additional incentives to an already posed transaction, it helps to create a new one. And so like kind of these bundles of fees and transactions allow, it kind of is like a bundle system, and it allows for everything to be pushed through rather than being like one being stuck and the other going through. So, okay, that was definitely a lot. So any questions there? Yeah. So we'll get into consensus a little later, but mining just talks about, they're pretty similar, but I'm not sure.
I mean,
So proof of work is the consensus mechanism, but mining is like
it's part of mining.
Yeah, it's a component. It's like a subcategory of mining. Yeah, or like it factors into mining for sure. Yeah. So that's the thing too. We see here that because there is, as we see, it kind of it's like approaches like asymptotically to this 21 million Bitcoin cap. We see that like as it gets closer and closer, each all the block rewards will be halved, and so it'll be less. You'll make less money from actually getting these rewards, but you'll never actually reach this cap, and so we'll never be out of Bitcoin. Yeah. Yeah, it can be, and it's like an additional like kind of sub clause that can be added, and like additional fees that are offered up if people pick up the transaction. We'll take one more question. Yeah. if something's stuck in the mempool. Then it's time to bump it up even more. Because the thing is, it all depends, it's all relative. And so fees and if people will pick them up or not, all depends on the current reference point of the rest of the transactions. And because it's you can think of it like a ranking too. If something's at the bottom, it doesn't matter if the fee is like really low or really small, but comparatively, they're always, like, people who are mining are always going to pick up the ones that have the highest rewards that come from them. So it really just depends on the other fees, and it's purely relational. Yeah. Not really a queue. It's like a queue that you can shift depending about it, and it all depends on how much you're willing to pay the people how much you're willing to pay the miners. And so if you really want this transaction to happen, you offer to pay them more through one of these options. And if you don't want it, then it might just be stuck there for a while. It just
So once the transaction is sent to the mempool of a miner, if it doesn't get picked up and it just sits there, then the transaction will never have gone through. It'll never be stored on the blockchain. So like you can't really cancel a transaction, but it just won't go through. You can think about it like that. The Bitcoin will never leave your wallet, and it will never go into the receiver's wallet. Can you repeat the question one more time?
Well, because we see that a lot.
I mean, if you are a user of the Bitcoin network and you actually care about your transactions going through, then you will either make sure. This is kind of like a marginal issue. Most of the time, the fee estimation algorithms work. Most of the time, you know what fee you need to put to go through, and it goes through. But in the case in which you care about using the network and your transaction doesn't go through, then you would fee bump. Otherwise, I don't really know who's just spamming miners, because if you don't care about your transaction going through, then you're not going to send transactions to the miners, because then you're just giving away Bitcoin at that point. In the case that it does go through. Does that make sense?
Yeah, the whole point of this is just to show that there is an option for something not to go through. And that's why we don't always need to see some kind of closure. If for some reason there aren't enough incentives in this network, then just nothing will happen. And that's all due to the fact that we don't have someone like running and orchestrating all this behind the scenes. Yeah, so this is where we'll see, kind of going back to this equation, we're going to see higher transaction fees. And that's the thing, it's going to be a slow transition too. And we might see people waning off of Bitcoin. Like, there's no real way to predict exactly what will happen. But what we know for sure is that these block rewards, or like pretty much we'll see a change because these block rewards will be carrying less weight as the amount of Bitcoin that is kind of gifted after every transaction will be lower. We're going to need to see higher fees, or people will choose not to really interact with Bitcoin as much anymore. So that's what we'll see. Okay, well, we should keep going. Okay, so we went over the revenue. Now let's talk about a few of the costs. So just to start with fixed costs, the first thing just comes down to hardware. And this is, to put it simply, you need some kind of device to mine Bitcoin. And so these are just a few different types here. So just to get right into it. So you have a CPU. This is what you might see as like a classic computer or a computer-like device. This one's pretty straightforward. In terms of hashes per second, it has like the computational power of like 20 million hashes per second. And so if on average this would take like a pretty long time to mine each block. And this, as you can see, that's in terms of years. Then if we switch to a GPU, this is what you see maybe more in gaming. It is able to maintain different tasks a little bit better, and it does have it's a lot more efficient than just a CPU. And so what we see though is in terms of inputs, it consumes a lot more energy, and there is more heat that's produced from it. And a few of the disadvantages we saw are that a lot of the components of the GPU aren't really being put to the not being optimized. And we see that there are functions that are built in that are meant for like kind of visual and audio purposes, and that aren't really relevant and aren't helpful at all for mining. Yeah. Do you want to answer right now?
I just wanted to talk a little bit about like why a GPU is so much faster than a CPU, and it's because like if you think about mining, it's like a computation that can happen in parallel. Like finding that nonce value is unrelated to trying out another nonce value, so you can carry out all the computations in parallel. And like the reason GPUs are used for like graphics processing is because they need to render like all the pixels individually. So GPUs are designed to do like parallel computation, and Bitcoin mining is also something that's like really lends itself easily to like parallel computation. And like as Nate goes over FPGAs and ASICs, they're they're integrated circuits that are designed specifically to do like Bitcoin's parallel computation.
Sweet, thanks JJ. And yeah, so just getting right here in FPGA, these are field programmable gate arrays. And so now we're starting to get into a little more of the niche applications. And these are like devices that are tailored towards Bitcoin, towards Bitcoin mining. And so what we see here is these are all things that are pretty much all like optimized to mine Bitcoin. And we see it's significantly faster than the CPU or GPU. And then just to get into so this is the application-specific integrated circuit. And kind of going into like kind of these last two. So what we see here, the difference is that it is kind of developed only to work with the SHA-256 algorithm. And so 100% of its purpose is going towards this hashing algorithm and trying to solve it, trying to find the nonce, and purely to mine. And so there are other components to it, but they all vary based off of like the fixed energy, electricity costs that go into it, mostly energy. And it also talks about size too. Like there are a bunch of things too in terms of price, size. Some of these are a lot more expensive, and it takes a lot more on the fixed cost side to purchase some of these than it does to like a computer, which from what I can see, most of you have one right now. So we're gonna keep going for now, and we'll come back to questions in a little bit. And then now to get into the variable costs a little bit. So one of the big variable costs is the energy consumed by mining. And especially in proof of work, we see that there's so much energy that is used, and that's pretty much poured into mining. And this is where this can end up being really expensive. So what we see here, a few of the more specific examples. We have energy to produce your hardware, so kind of all the energy that goes into from the factories and from the companies to actually building whatever hardware it is you're using. The electricity, which you probably pull from the grid, that is used to power your hardware to make sure that your computer or your GPU, any of these devices are running. And then even cooling too, because these get really, really hot a lot of the times because they're running so much. And so the cooling is another cost that's sometimes often neglected too, but it is a huge factor. And then it takes infrastructure to warehouses and personnel, all things to monitor these devices, to run them, make sure everything's running. And now we'll just get into, we'll talk a lot more about the environmental impacts of this later on in a different lecture. But pretty much here, we see that all energy is converted to heat. And this gets into the idea that a lot of the times, this is a really expensive and can be kind of wasteful too, because all this energy only goes into solving a hashing algorithm, which is pointless except for the fact that it allows for a randomly generated, or not quite randomly generated, but like we talked about last time, it allows for the network to run. And so this energy isn't really being put into anything other than kind of proving, it's proving that it's like proof of work. And so the only purpose of it is for consensus. And so that's why we've seen the shift to proof of stake and other consensus mechanisms, which we'll talk about soon. And that just goes to show that if we shift to other consensus mechanisms, we might not waste all of this energy. Okay, and then that just goes into incentives. And so we just went over the revenue and costs and the components that went into them there. Any questions there? I'll probably just get 2 or 3. Yeah. And they're used, especially the ASICs specifically. Any other questions? Yeah. Well, Ava will get into those in a second. Yeah, we'll get. It's a great transition. Maybe one more question. Yeah. What was that? The big trade-off here, as we see here. So the big difference is rather than being like fully all into designing for SHA, it kind of has more general purpose as well, and so it has some more versatility to it, but it is very, very concentrated on trying to solve like SHA-256 and like working with that algorithm or with that hashing function. Okay, Ava, take it away.
Thank you.
Of course.
All right. Thank you, guys. I know this has been a very long lecture. This is the very last section, so thank you for paying attention. So I'm going to go into real-world mining and what mining actually looks like today. So this is what a Chinese ASIC mining farm looks like. You see all these are ASICs up there, and you have a specific way to cool down the machinery. So there's different ways to cool machinery because they're so hot all the time and you want them to keep running. So this is water cooling on the bottom. You see fans on the left. And you just see like if you can see on the right here, these are tubes of water that will are like channeled through the mining farm just to make sure that every single ASIC is running at top speed. And then these are just different types of machinery. I think those are ASICs on the right. This is what a GPU looks like. That's an ASIC miner, power supply. So these are just different hardwares that you can look at just to see what it actually looks like in the real world. And then if you are an individual, you might be in this classroom today and you want to get involved with mining, you're probably going to do some research and realize that it's really not profitable for you on your own to go out and buy an ASIC and start mining Bitcoin and just hope you get lucky. So people will pool together in these mining pools that allow individual miners to pool together their computational power and actually stand a chance at finding a Bitcoin and then distributing it amongst the pool. So it reduces the variance in mining rewards because if you get a mining reward, you're not going to keep the 6.25 Bitcoin to yourself. You're going to have to share it with the mining pool. But at the same time, if someone else in the pool gets that reward, they're going to distribute it to you. And it's usually run by a pool manager or a pool operator who takes a cut of the mining rewards. And there's different ways that these pools are run. I think that there's there's like a proportional pay per share, and then there's also proportional payouts. So there's different ways that these pools decide to run themselves. But basically, we just want to share this as an opportunity if you are an individual who wants to mine. There's different ways to mine than just either being in a pool or being a full-fledged Bitcoin mining company. There's different ways that you can get involved with mining. Oh, yeah. So this is a very short section just to get you familiar with what it looks like.
We'll transition in the next lecture, too. We'll be talking about different pools a little later.
Yes. Next lecture is awesome. It's about game theory and attacks. Very exciting. Very cool. If you have any questions, stay after and ask. The attendance code for this week